Welcome to Iron Financial. We are the Explainer series completely dedicated to helping you forge a stronger portfolio and really cut through the market weakness. I'm your lead analyst, and honestly, my job here is to tear down the financials. We look at the revenue, we dig into the debt, we analyze the margins, and we figure out what's made of solid steel and what's just built on sand.
And I'm your co-host, the Market Skeptic. I'm basically here to ask the hard questions on behalf of you, our audience. Because let's face it, I want to know if the numbers we're seeing on these earnings reports are showing real structural strength, or if it's just a whole lot of really expensive hype masking a failing foundation.
Today, we are putting JD.com right under the hammer. We are looking closely at their Q1 2026 financial filings. Listen, JD.com isn't just another retailer. It is an absolute bellwether for the entire Chinese consumer economy. And it's a titan of global supply chain resilience. Literally, when JD moves, the whole market shakes. But their latest numbers are presenting a massive, complicated battleground for investors. So is this stock a solid, unbreakable foundation for your portfolio, or is it a structural trap just waiting to collapse? Let's dive right into the numbers and stress test this giant.
Okay, so let's just jump straight into the biggest, most glaring contradiction in this entire earnings report. When I look at JD.com's Q1 2026 numbers, I see a company that is reporting just a truly massive amount of revenue. Over 315 billion RMB. I mean, just to put that into perspective for a second, pulling in that kind of cash in a single quarter, that means they are moving an absolutely unfathomable volume of goods. We're talking millions of pallets, billions of parcels, day in and day out. But at the exact same time, their bottom line net income is bleeding out, and it's bleeding heavily. As an investor, when I see the top line expanding like that, but the bottom line contracting so violently, the alarm bells start ringing immediately. You have to ask yourself, why is a company bringing in more money than ever before, but keeping so much less of it? Are they literally just buying revenue at this point? Are they losing their pricing power because the market is just too hyper-competitive? Those are absolutely the right questions to ask, for sure. But to really understand the architecture of this earnings report, we have to isolate the different pillars of their business. You can't just look at the outside facade, you have to look at the load-bearing walls inside. Let's break down exactly what is happening with that top-line revenue first.
Look at this number. I mean, really look at it. 315.7 billion RMB. That is JD.com's net revenue for just the first quarter of 2026. This is not just a big number, it actually represents a 4.9% year-over-year growth compared to the first quarter of 2025. And we have to remember the context here. We are in a macroeconomic environment right now where consumer spending has been heavily scrutinized, and the retail sector is facing some serious headwinds globally. But JD, they are out there doing the heavy lifting. They are forging ahead despite the gravity that is pulling down the broader sector. Now, their net product revenues increased by 1%, which is fine, but more importantly, their net service revenues absolutely surged by 20.6%. This is crucial because it shows that their wider ecosystem, we're talking their third-party logistics, their marketplace merchant services, that whole side of the business is driving serious, high-margin volume. This is a testament to an incredibly robust operational foundation.
Okay, I hear you on the top-line strength. It's impressive. But let's look at the brutal reality of the bottom line, because this is where the story changes. Net income attributable to ordinary shareholders back in Q1 of 2025 was a very healthy 10.9 billion RMB. Fast forward to Q1 2026, and that number has literally crashed to just 5.1 billion RMB. I mean, we're looking at more than a 50% drop year over year. You can talk about heavy lifting and macro resilience all you want, but if the foundation is supposedly so strong, why is the pure profit getting completely cut in half? Think about it. A structural beam that loses 50% of its load-bearing capacity isn't exactly a beam I want to stand under. Where is all this cash actually bleeding out? And how long can management sustain this kind of structural pressure before something gives? To answer that, you really have to look at where the core structural integrity of the company actually lies. And the bull case here is illuminated perfectly when we look specifically at JD Retail. JD Retail is the main engine of this entire company. And guess what? Its operating margin didn't shrink. It actually climbed to a record 5.6% for the quarter. That record margin drove a staggering 15.0 billion RMB in operating income for the retail segment alone. And how are they doing it? They're deepening these massive strategic partnerships with home appliance heavyweights, brands like Media, Haier, Hinson, and TCL. By locking in exclusive inventory with these giants and driving much better margins through their sheer scale, JD is creating a massive competitive moat against its rivals. So the core retail business isn't bleeding at all. It is actually stronger, more efficient, and more profitable than it has ever been. But honestly, that is exactly the problem. If JD Retail generated 15 billion in operating income,
But the company's overall income from operations plummeted to just 3.8 billion RMB, down from 10.5 billion a year ago. That means management is aggressively bleeding out the hard cash generated by retail just to prop up weak, unproven new business initiatives. The overall operating margin crashed from 3.5% all the way down to 1.2%. The earnings report specifically cites increased strategic investment in new business initiatives. So are they just throwing good money after bad? What happens when you burn all this hard-earned retail cash on unproven tech ventures? Is this supposedly solid foundation being actively compromised by a reckless expansion into a financial black hole?
All right, let's move into Section 1, Cracks in the Armor. We need to talk about corporate governance and the data nexus fallout. Because it's definitely not just the margins that have me worried right now. Let's pivot completely away from the glossy earnings press release for a minute and look at the gritty reality of their SEC Form 20F filing. This is their massive annual regulatory filing for foreign companies traded in the U.S., and this is where we start to see some severe, undeniably deep cracks in the armor. When you are assessing a company's foundation, corporate governance is the concrete that holds everything together, right? If the concrete is bad, the whole building is at risk. I am reading directly from JD.com's own SEC filing here. Regarding their subsidiary Data Nexus, the filing clearly states that during a routine internal audit, quote, suspicious practices were identified that may cast doubt on certain revenues, and it explicitly mentions the risk of fictitious transactions. This led to a massive independent review in early 2024 and ultimately a putative securities class action lawsuit which dragged JD.com in as a defendant. They actually had to settle this class action with final court approval granted in March 2025. So I have to ask, are JD's internal controls actually built on sand? How much more structural rot is hiding just under the surface here?
Well, you call it rot, I call it a stress test that the management team passed decisively. Yes, the data situation was a crack. There's no denying that. But look at how JD actually repaired it. They didn't just let it fester. In April 2025, they entered into a merger agreement to initiate a going private transaction for Data. By June 2025, JD fully acquired the remaining Data shares at $2 per ADS. They absorbed it completely. By bringing it entirely under common control as a wholly owned subsidiary, JD completely eliminated the public market liability, they centralized the oversight, and they basically poured new reinforced concrete right over the compromised area. That is exactly what strong, capable management does when they find a weakness in their structure. They fix it.
Wow, that is a very generous interpretation. I see it as a very, very expensive cleanup operation. And honestly, when you juxtapose this reality against JD's massive PR machine, it gets incredibly concerning. On one hand, JD boasts this sprawling ecosystem of over 900,000 employees. They publish these glowing ESG reports talking all about their green awards, their advanced solar roofs, their state-of-the-art warehouse cooling systems, and massive employee dormitories and welfare programs. It paints a beautiful picture of a flawless, futuristic enterprise. But on the exact same hand, a major subsidiary was literally caught up in fictitious transactions. It really makes you wonder if an ecosystem of nearly 1 million people is simply too sprawling, too massively bloated to effectively govern. Big numbers and shiny green awards can be really impressive, but they can also be a very convenient smokescreen for internal audit failures.
Okay, let's transition to Section 2, Heavy Lifting. We're going to talk about forging new pillars with spin-offs. Let's refocus on the physical and financial infrastructure being built here, because this is where the long-term value of JD is actually forged. While you are hyper-focused on the data cleanup, JD has been out there doing some serious heavy lifting by forging entirely new structural pillars. We are talking about JD Logistics and JD Industrials. These aren't just little side projects. These are reinforced steel beams securing the company's future dominance in the market. JD Logistics is currently executing a massive structural modernization that's derived straight from those ESG reports you mentioned. They are literally building a green, low-carbon supply chain. We are looking at massive, highly intelligent industrial parks completely outfitted with photovoltaic power generation systems on the roofs. This drastically lowers their reliance on the traditional power grid. And listen, this isn't just about winning green awards. This is about replacing expensive fossil energy, locking in permanent, long-term energy cost reductions, and building a physical infrastructure that can sustainably support a 1 million-man workforce globally. And this brilliantly illustrates the technological moat they are actively building right now. Inside these massive warehouses, JD Logistics has actually deployed these highly upgraded Lengzhu Tech Packer robotic arms. And they're all powered by what they call the Jingdong Logistics MetaBrain. But listen, this isn't just basic everyday automation. The MetaBrain AI is literally predicting order flow. It's dynamically optimizing picking paths in real time. It's drastically reducing the actual physical footsteps required by their human workers. These are embodied intelligent robots specifically designed for high-speed parcel picking and cage loading, and they are being deployed at a massive industrial scale. This is exactly how you take a colossal 900,000-person headcount and start driving exponential efficiency gains. You reduce the reliance on manual labor for those repetitive tasks, you crank up the sorting speed, and you permanently lower your fulfillment costs. That right there, that is pure, unadulterated structural strength. Furthermore, they are actively monetizing these exact pillars to fortify their balance sheet. In December 2025, they successfully executed the Hong Kong IPO for JD Industrials, trading under the stock code 7618. This global offering successfully raised approximately 2.6 billion RMB in net proceeds. That is billions of dollars of fresh capital injected straight into the foundation of the parent company. It proves that the public markets have an immense appetite for JD's operations. Investors clearly recognize the standalone value and the raw power of their technological and industrial supply chain assets.
And JD Industrials isn't just sitting back resting on its IPO cash either. Their Q1 2026 performance was absolute iron. They reported an adjusted non-IFRS net profit of 229 million RMB, which is a massive 54.4% year-over-year surge. They are aggressively expanding their industrial footprint, deepening strategic ties with global manufacturing heavyweights like 3M China, Lind Forklift Truck, and Sata Tools. And just to prove their absolute conviction, the JD Industrials board just authorized a brand new $200 million share buyback program. Think about that. When a newly public subsidiary starts aggressively buying back its own stock right out of the gate, that screams management confidence and supreme operational cash flow.
Look, I won't deny that the robotics look incredibly impressive, and raising 2.6 billion RMB is definitely a solid liquidity event. But I have to push back hard here because we really need to look at the macro picture. JD is burning cash at the group level. Remember, overall operating income dropped from 10.5 billion way down to 3.8 billion. We are witnessing brutal, relentless price wars in Chinese e-commerce right now, and the fight for consumer wallet share is fiercer than it has ever been. So, are these spin-offs and IPOs actually true pillars of strength, or are they literally just expensive window dressing? Is management intentionally hyping up green warehouses and AI packaging robots just to distract investors from the fact that the core retail expansion is experiencing massive fatigue? Are they bleeding their retail cash into black hole new initiatives simply because their main growth engine is stalling out? Raising 2.6 billion from JD Industrials is great, sure, but does it actually justify the billions they are actively burning everywhere else in the company?
Let's move to Section 3, the verdict. Is JD.com a structural trap or a foundational opportunity?
That is the ultimate question we have to answer today. We've laid out the steel beams and we've inspected the cracks. It's time to bring all these data points together for our final iron financial breakdown. We need to synthesize the margin strength, the governance issues, the spin-off capital, and that profit contraction to deliver a no-nonsense verdict on this stock. For me, the verdict is entirely written in how management is allocating their capital. Open market stock purchases are the ultimate lie detector for a management team. If you want to know if the foundation is really cracking, look at what the architects are doing with their own money. In Q1 2026 alone, JD.com executed aggressively on their share repurchase program. They bought back approximately 44.5 million shares. They spent $631 million in a single quarter buying their own stock. And they still have $1.4 billion remaining in this specific program. Listen to me, you do not buy back that much stock at that aggressive of a pace if your foundation is failing. You do it when you know the broader market has fundamentally mispriced your steel.
And let's zoom out just a bit to look at the sheer weight of their capital return over the last year. In 2025, under their previous authorization, JD.com spent a staggering $3.0 billion on share buybacks. $3 billion. They retired over 91 million ADSs. When a company is generating the massive free cash flow required to return $3 billion to shareholders in a single year, while simultaneously investing heavily in warehouse robotics, scaling European logistics with Joybuy, and hitting record 5.6% margins in their core retail business, that is the very definition of foundational strength.
Let's look at the tail of the tape before we get too carried away here. On the Bull Foundation side, yes, the core retail margin hitting 5.6% is genuinely fantastic. Raising 2.6 billion RMB from the JD Industrials IPO is phenomenal capital raising, and spending $631 million on buybacks in a single quarter definitely shows they have deep pockets and a lot of cash on hand. But you absolutely cannot ignore the bearish cracks in this foundation that we've laid out today. Net income literally crashed from $10.9 billion to $5.1 billion. Overall operating income was slashed from $10.5 billion all the way down to $3.8 billion. And the ghost of the Data Nexus fictitious transactions proves, beyond a shadow of a doubt, that their internal controls are simply not bulletproof. That is a massive amount of weight and serious risk pressing down on those newly forged pillars. And that brings us to the final test. We've shown you the top-line growth and the brutal bottom-line bleed. We've shown you the record retail margins and the heavy futuristic investments in robotics, AI, and global supply chain infrastructure. We've also highlighted the severe corporate governance hiccups and those aggressive multi-billion-dollar buybacks that prove management's ultimate conviction. So I leave you with this provocative question to answer for your own holdings. Is your portfolio forged strongly enough to buy into JD's massive heavy lifting and their long-term supply chain dominance? Or are the short-term profit bleeds and corporate governance cracks simply too deep for you to ignore? That's the breakdown. Do your homework, stress test your thesis, and keep your portfolio forged in iron. We'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.